Good morning, everyone, and welcome to the Moneycontrol live stream. You're watching Markets with Santo and CJ. Although, apologies, Santo is not here today. He's a little under the weather, but don't worry, I'll take up the baton for him. That said, we have a lot to digest. A lot is happening across the world in financial markets as well as in political spheres as well. And the country that we are putting in spotlight or discussion topic for today is, of course, China. There is nothing else to discuss at this point of time across the world. The biggest story is breaking out from China at this point of time, and we're going to delve into what's really going on in that country and how, if at all, it could benefit India in the long term. Now, the unthinkable has happened in China after after 2 years of what has been a very strict and very harsh COVID policy from the Chinese authority. People are finally out on the streets and protesting. Now, if you look at, several cities, several major cities, including the financial district and probably one of the biggest cities in Asia, Shanghai, protests have broken out across universities, schools, roads, even factories. We have already seen, videos circulating of protests at Foxconn's factory, which is the manufacturer for Apple iPhones. So clearly, there is a lot of discontent on the ground in China, and this is really probably one of the biggest protests that we are seeing in China since the Tiananmen Square massacre in 1989. Now, what has triggered these protests? Well, a few days ago, there was a fire in a building in Urumqi, which is the capital of the Xinjiang region of China, towards the western side of China. Now, the reason that a lot of people allege that, almost 10 people died in that building fire, was largely down to the fact of COVID restrictions. Now, according to a lot of, anecdotal evidence coming out of that country, people are being locked inside because of the zero COVID policy of the Chinese government, and that triggered massive protests and frustration boiling out on the streets of China at this point of time. People have gone so far as to call for resignation of the President Xi Jinping as well as the Chinese Communist Party. So it is clearly escalating, and you can see that impact on the financial markets as well. Hang Seng Index down 4% today. Hang Seng Technology Index down 5% today. The Shanghai market is also down in the red, and the impact is now being felt across Asia, with major markets from Nikkei to Singapore starting the week off on the in the negative side. So what could be the implication here going ahead? Now, if you look at some of the commentary that has happened over the past couple of months, ever since that tech purge that the Chinese government started last year, a lot of people have been looking at China as somewhat of an uninvestable habitat now for investors and global capital. Now, we have heard a lot of people, very big dignitaries, very big brains in this market, call India the next destination to go for foreign capital when China becomes uninvestable. And we have seen that in the way that India's weight has increased in MSCI Emerging Market Index, at the same time while China's weight has decreased quite sharply. Going ahead, with the rising political uncertainty now on top of the very strict COVID policy and how it has affected supply chains, clearly it should benefit or at least add to India's image as being a more politically stable, business-friendly environment, and maybe attract even more global capital as it has done probably in the past 12 months. Apart from that, the medium-term benefits of this could be, now of course, whatever is happening is of course unfortunate, but Goldman Sachs is of the view that given the pressure from the people at this point of time that we are seeing in terms of the protests, it could force the Chinese government to actually get out of its zero COVID policy much sooner than what market or investors were expecting. Now, recently there were murmurs that China could relax its COVID zero policy. We know that it did relax certain quarantine norms with respect to travelers coming into certain cities. But overall, the Chinese government has indicated that it has no intention at this point of time to relax its COVID zero policy, especially at a time when it's seeing a very fresh breakout in COVID cases. One of the biggest national dailies in China, in fact, this morning wrote an editorial backing the government's zero COVID policy despite the sort of protests that we are seeing. Now, if we do see the government buckling under pressure and easing COVID lockdowns, that could clearly be very beneficial as far as global supply chains are concerned. Remember, the impact of the pandemic on supply chains is or was one of the major triggers for the sort of rapid inflation that we have seen in many Western economies, including, in Asian economies like ours. Supply chain factors have also been one of the reasons why a lot of automobile makers, a lot of consumer electronic goods makers have had or seen rising input prices, and it has led to overall general inflation. So going ahead, if China is forced to ease its lockdown, then definitely it is going to impact the inflation picture, and probably central bankers may not have to continue the rate hike cycle that they have been continuing for the past 12 months now. So overall, if you look at it from India's perspective, it just seems to be that probably for India, this could end up being a win-win situation, whereas for the global economy, the positives may come in the medium term, but at this point of time, the negatives would be that this will further raise question marks about China's global economic might, as well as an impact on the global economy in 2023. Remember, this is in the context of a feared recession, not only in Europe, but as well as in US as well next year. So let's see how that dynamic improves. But overall, it seems from India's perspective and India's capital market perspective, this could turn out to be a win-win situation in the long term. That said, CLSA, came out, Lawrence Blanco, one of the, marquee technical analysts out there in the world, he came out with a short note earlier this morning indicating that Nifty has most likely made a fresh breakout now, and probably the initial target for that index now would be somewhere around 20,185. That is almost a 1,500 point gains that Blanco is indicating at this point of time, and if it does turn out to be that way, then clearly it will be a very, very strong start for 2023 for India. Well, that is about China. Let's take a look at now how the trade setup is shaping up for our markets this morning. And clearly, it is a negative setup, of course. I mean, sentimentally, what is happening in China has had a rub-off effect across Asian markets. At this point of time, the SGX Nifty futures are indicating almost a 50 to 70 point cuts for our benchmark index as well. Also, cues from European markets were not that great. Of course, US markets were only working half day on Friday owing to the Thanksgiving weekend, but European market cues from there were also not that great amid low level of participation in those markets. Another positive, of course, that could be for India is crude oil prices. Now, crude oil prices have slumped to the lowest level since 2021. Clearly a very major positive. Also, this is happening largely because of concerns about demand in China. Now, a lot of people were expecting that with China probably opening up in 2023, crude oil prices will continue to, firm up from the current levels of about $80 to $85 per barrel. But now, WTI US crude has fallen below $75 per barrel for the first time in a long time. Brent futures are heading towards below $80 per barrel. So clearly that is a very, very good sign as far as inflation is concerned from a domestic point of view. Overall, looking at the FNOQs, if you look at the FNOQs, clearly there was a strong amount of call writing happening at 18,400 level for our index on Friday. So that is clearly going to be a firm support for our markets if we do see some bit of acceleration in losses later in the day. So that will act as a support. Individually, from a stock point of view, Siemens, ICICI Prudential Life, these were the two stocks that saw a sharp rise in short positions on Friday, while on the long side, Indiabulls Housing Finance as well as Bharat Heavy Electrical, these are the two stocks that saw a massive build up in long positions on Friday. So those will be the four stocks to watch out for clearly in trade this morning. Moving on to our next segment, and this is newsmakers of the day. Tata Motors, first up is Tata Motors. Largely, of course, you would have guessed because of China, of course. I think the intensifying, concerns around the Chinese economy will have an impact on Tata Motors, largely because of the fact that JLR does have a massive exposure to that market. Now, recently, the Chinese consumer car market was seeing some bit of revival, but with the nationwide protests now happening, we know that these sort of uncertainties tend to impact consumer demand, especially discretionary demand. So probably that could hurt revival prospects for JLR going ahead in the second half of FY23. Also, JLR has announced production cut in the UK owing to the shortage of chips that it continues to face for the past 12 to 18 months now. The only positive side that could offset this news is the news emerging that the government has now, asked most of its facility, departments, state government, local governments, to scrap any vehicle that is older than 15 years. These vehicles will no longer be re-registered, and they will have to go through mandatory scrappage. So that should probably give some sort of boost to the domestic operations of Tata Motors. But clearly, the major chunk of its earnings, which come from JLR, that will remain under pressure going ahead. The next stock that would be a newsmaker today would be Paytm. Now, the stock will be in focus largely because the RBI has rejected the company's license to become a payment aggregator in India. It has asked Paytm to not onboard any new online merchants on its Paytm payments app for the time being. The good part is that they have asked, the regulator basically has asked Paytm to reapply or resubmit its application for payment aggregator. So clearly, all hope is not lost for the company, but at this point of time, sentimentally, it could be a little bit of a dampener for the stock. Moving ahead, the top brokerage bets of the day, and these are, of course, Larsen and Toubro. Citigroup came out with a report today on the company. Now, they have reinitiated coverage on the stock with a buy rating and a target price of 2,464, clearly indicating a very massive upside from current levels. Now, they believe that the company will be a chief beneficiary of the growth in capex or capital expenditure, not only in India as well as in West Asia as well. Now, we know that higher crude oil prices tend to be good for a lot of Middle Eastern economies, West Asian economies, and generally that leads to a lot of growth and a lot of infrastructure development there. And L&T being having a large exposure to that market, clearly is expected to be a big beneficiary in that in that space. Overall, also given the fact that commodity prices have now stabilized to a certain extent, that should also aid margins of the company in FY24 as well as FY25 in the view or in the opinion of Citigroup. Also, the brokerage said that the company's very sharp focus on ESG, improving its ESG rating as well as improving its return on equity, clearly bodes well for investors in the long term who have been investing in L&T. So a lot of good pointers coming out from the house of Citigroup at this point of time for L&T, and clearly investors may react very positively to these point of views. The second stock would be Voltas. Anand Rathi came out with a note on the company after its earnings. They have retained their buy rating, but they have very sharply cut their target price on the stock to 986 rupees. Now, the target price has been cut by 20%, over 20% actually, due to Anand Rathi expecting a lower EBITDA performance from the company in FY23 and FY24. They have cut their EBITDA estimates in excess of 15 to 20% for FY23 and FY24. But that said, they believe that Voltas' return on equity will hit a bottom of 7% in FY23 and therefore will start recovering from FY24 onwards. Now, the brokerage firm also has given us confidence that they expect Voltas to retain their leadership in the current market, in the market that they are functioning. They currently are leading the second best player in the market by as much as 700 basis points in terms of market share. So clearly, they are not seeing any sort of risk of Voltas losing its numero uno position. Moving on, the next segment of the day is stock takes. Now, there are three stocks that I really want to talk about. These are IEX, Concor, and HPCL. Starting off with IEX, well, the company has announced a share buyback program. Now, we know that the stock had been under pressure, down 45%, but they have announced the buyback program of buying 4.9 million shares at 200 rupees per share, a premium of 50% from yesterday's price. They are also going to venture into carbon markets going ahead, so that is clearly positive news, and clearly this stock could be a tactical buy for traders in today's market. That said, we have the opening bell on the market, and clearly it has been a negative start. We can see the Nifty is down about 56 points, Sensex down about 200, almost 300 points at one point of time, now down about 220. So market is just finding its feet, but the advance to decline ratio clearly is in the favor of the bulls. About 1,300 stocks rising on the NSE, whereas almost 600 stocks are at this point of time down. If you look at the mid-cap and the small-cap indices, those are the ones that are clearly have continued from where they left on Friday, outperforming their larger cap peers. And if you look at it in terms of stocks, banking names are the big losers. HDFC Bank, IndusInd Bank, ICICI Bank down about 0.3 to 0.8% at this point of time. Brent has now fallen below 82, although there is, that has led to a good spike in BPCL, up about 1.4% at this point of time. So clearly, sort of a negative start, sort of a muted start, but it will be interesting to see if we do see some recovery in the Nifty and the Sensex later in the day. Coming back to, the stock takes, the second stock on my radar today would be Concor, Container Corp. Now, why I'm going to talk about this stock is because generally, of course, the point of view from analysts on the street on Concor has been quite positive, even though the earnings for the September quarter were a little bit of a dampener. But, a new rating, new coverage basically has come in from the House of Macquarie. Macquarie Capital has initiated coverage on the stock with an underperform rating. They believe that the delayed completion of the dedicated freight corridor till Jawaharlal Nehru Port will actually lead to volume growth loss for Concor. They believe that this is going to adversely impact the volume growth projections that Concor has been giving to analysts for FY23 at this point of time. They also believe that this could possibly lead to further loss in market share as well as pricing pressure, because they will face, of course, more competitive intensity in those lines, and that could possibly offset any sort of benefit that Concor might get in the medium term from the completion of the dedicated freight corridor, which is expected to be probably mostly commissioned over the next 3 to 4 years. So clearly a contra view coming out from Macquarie on Concor, and it will be interesting to see how the stock trades today. At this point in time, clearly investors are shrugging it off. Concor is higher by about 0.4%, as you can see on your screen. So interesting point of view. And of course, that is always welcome. A different point of view is always welcome in the market. Moving on, the last stock on my radar today would be HPCL, Hindustan Petroleum. Now, this is one stock that has taken a lot of beating this year because of the inability of, oil marketing companies to pass on, the surge in crude oil prices, which is a raw material for them, to end consumer whom they sell processed products out of these, crude oil. That clearly has led to a sharp decline in HPCL prices. Valuations at this point of time are quite depressed. But, JP Morgan is of the view that slumping oil prices could actually now lead to a reversal in the fortune of the company. The brokerage firm has upgraded the stock to a buy rating, citing the fact that the recent correction in, crude oil prices could stay here for a long time. Now, of course, as I mentioned earlier, China, the issue around China, possible recession in Europe as well as US, clearly the demand picture for crude oil is not looking that great, and therefore any hopes of a bounce back at this point of time, the probability of that is looking lesser and lesser as the days go by. So clearly a very good point of view coming out for HPCL. Now, JP Morgan also noted that the money that, or the margin that HPCL makes from sale of petrol as well as LPG, that has actually turned positive after being in the negative for most parts of 2022. Also, the losses that they are facing on diesel, which is one of the biggest consuming or the highest consumed refined product in India, the losses on diesel are also narrowing on a month-on-month basis. So clearly a lot of positives for OMCs in general, but HPCL in particular, because HPCL clearly has a larger share from oil marketing income compared to BPCL and Indian Oil, and you can see that in the stock performance today, higher by about 4.5%. So clearly there could be a good tactical trade as far as HPCL is concerned. Well, on that note, let's wrap it up for today. Keep posting, keep commenting, keep letting us know how you feel about the show, and of course, you can keep following us on the social media links that you can see at the bottom of your screen. And for all your financial news, there's only one place to be, that is moneycontrol.com. We'll catch you live again at 3 p.m. Till then, have a great trading day.